Thank you for coming in, Mr. and Mrs. Stewart. I appreciate you meeting with me today because I know that your time is extremely valuable. So I want to make this meeting as productive as possible. Now, we have a lot of goals to address for you, but today I wanted to address one specific goal, and that is your life insurance needs, especially yours, Frank. Before we dive into the analysis, I wanted to go over a couple of the assumptions you and Madelyn had provided to me. Now, the calculations were based on these assumptions that you currently earn, Frank, $170,000. You have a combined federal and state marginal tax rate of 31%. You have a consumption rate of about 15%. You expect a 4% annual increase in your salary, and you plan on retiring at about age 67. Now, Frank, currently you have a $50,000 group life insurance policy with Lakeside Hospital. Based on your expressed goals of increasing Frank's insurance and on my estimations and calculations of your current coverage, you guys are way underinsured. Now, I've given you a copy of the calculations so you can very easily follow along. And so, here's what we did. I used the human life value method to determine what your needs would be for your life insurance. The human life value method calculates Frank's income earning abilities as the basis for determining the required amount of life insurance, then projects what Frank's income will earn during his employment career, and then uses a discount rate to determine its present value. Now, let's run through the numbers. First, we need to determine Frank's share of the annual earnings, equaling $170,000. We're then going to subtract the combined federal and state marginal tax rate of 31%, arriving at a total amount of $52,700. We're going to then multiply that amount by your consumption rate of 15% to equal our after-tax earnings of Frank's share of earnings, of $99,705. Next, we had to take a look at Frank's work-life expectancy. Frank, you'd mentioned that working until age 67. Now, that gives you 32 more years in the workforce. We then calculated Frank's share of earnings through full retirement. We took that $99,705 mentioned earlier as a payment over the next 32 years and adjusted it by the amount of a 4% increase in salary that we're expecting, for a total future value of our work-life expectancy of $6,251,650. Finally, we brought the future value back into today's dollars, where we took the future value of the 6.25 and discounted it to the average inflation rate of 3% over that same 32-year period to arrive at our current present value for life insurance using the human life value method, and that gets us to a total life insurance need of $2,427,747. Now, I recommend a 30-year term policy for the $2,427,747 with a permanent insurance conversion option for Frank. Just because the group coverage may not be convertible after Frank's employment ends with Lakeside, I wanted to make sure that the policy provided adequate coverage to reach your goals over the next 30 to 32 years, at which time you should be self-insured anyway. Now, the term policy should provide for a full conversion to permanent insurance at any time during the 30-year period. Now, this will allow Frank to convert the policy to a permanent policy such as a universal life, a variable universal life, and or a whole life policy depending on the insurance provider. If you guys prefer to keep the policy past the initial 30-year term. Now, I recommend we get this policy put in place as soon as possible. Assuming good health, the following insurance estimates were provided to me through a couple of carriers. For the $2.4 million 30-year term policy with a preferred risk class, we see a premium of about $200 a month. Now, I recommend when submitting the application that we include at least 1 month's worth of premium, so that way we can bind the contract through underwriting just in case the unforeseen or unfortunate happens during the underwriting process. Once the policy is approved, you guys need to accept delivery of the policy and sign and return all of the appropriate paperwork. Now, in doing this, that will help us cover all of the insurance needs that we have for Frank. Now, this was the main issue that I wanted to cover today. And when things come up that we can implement sooner than later, I like to address those first. Now, we will certainly be meeting over the next several months to take care of a lot of the other issues and goals and objectives that we previously discussed, but this was the main goal that I wanted to discuss today. If you have any other questions or concerns, we can discuss the roles and talk about the specifics from there. But otherwise, I truly thank you guys for coming in today, and I look forward to helping you implement those strategies that we've discussed, and want to thank you for your time.